Thank you very much, Lars, and I want to thank all the organizers for inviting me to this webinar series. Today I want to talk about some work with Dan Greenwald and Martin Lettau. Dan is here to help answer questions during the chat. And in this study, we're posing a very simple question. Now, simple and easy are not synonymous, hence the reason that this has taken us a few years to get to this paper. But our question is, why do stocks rise and fall? Now, surprisingly, little academic research has been devoted to addressing this question in asset pricing. Much of the literature has concentrated on explaining expected returns over, say, quarterly or annual frequencies, in particular risk premia. And so here we want to take a longer view and consider the forces that have driven the overall value of the market during the post-war period. So some basic empirical facts will serve to motivate our investigation. The stock market has risen sharply over the post-war era, and this has actually been driven mostly by the last 30 years. So here what we're plotting is, or what we're reporting is the average annual growth for the US corporate sector in market equity, in output, and in earnings over two different sub-periods. And what you can see is that from '89 till the end of 2017, which is where our sample ends, that's actually 29 years, the real value of the market equity for the US corporate sector grew at more than 4 times the rate of the previous 29 years. Now, by contrast, the real value of output shows the opposite temporal pattern. So output grew much quicker in this time period. This is the output of the corporate sector in the previous time period from 66.1 to 88 Q4 than it did in the most recent time period. And if you look at corporate earnings, the pattern reverses yet again. So corporate earnings grew very quickly in the more recent subsample and grew rather sluggishly in the previous subsample. So what's the upshot of this? It is a widening chasm between the stock market and the broader economy, which we can also see in the next plot. And here what we're showing is a plot of the value of market equity for the corporate sector relative to 3 different measures of aggregate economic activity, GDP, personal consumption expenditures, and the measure of output for the corporate sector, net value added. And so you can see that relative to these 3 different measures, this ratio is at a post-war high at the end of our sample. And tellingly, the market equity to earnings ratio is not near a post-war high. So textbook economics would teach us that the stock market and the economy should contain a common trend. Now this goes back at least as far as a paper by Klein and Kosabud, but it is followed by a vast literature in macroeconomics that presumes balanced growth among economic aggregates over long periods of time. So the same factors that boost the economy are supposed to be the key to rising equity values over long periods of time. Now, the previous figure suggests, well, maybe this tenet of macroeconomic theory is not borne out by the data. So then our question is, what is responsible for the sharply rising equity values over the post-war era? How is the wealth won? So to address this question, we'll need a model of how equity is priced, and that's because theoretical factors other than growth could have predominated over long periods of time if they are persistent enough and large enough to overcome the drag from a sluggish economy. These include factors such as changes in how the rewards from production are expected to be apportioned to shareholders relative to other claimants, changes in how expected payments to shareholders are discounted back to the present, and this includes expected path of future short rates as well as risk premia. And at the end of the day, economic growth could still be the key to the market's rise over the post-war period, even if the last 30 years have been a striking exception. Now, to foreshadow the potential importance and foreshadow some of what we find in the potential importance of the first numbered bullet point above, wide and persistent swings in the corporate profit share of output have caused long-lasting deviations between corporate cash flows and the value of what the sector actually produces. So the corporate sector after-tax profit share of output ranges from less than 8% to nearly 20% over our sample. So in this paper, we construct and estimate a model of the US equity market. Now, the imposition of a model necessarily imposes some structure, but our approach is intended to allow the data to speak as much as possible. We do this by estimating a flexible parametric model of how equities are priced. It allows for influence from several mutually uncorrelated latent factors. And then we infer what values those latent factors must have taken over the sample to explain the data. And so the identification of mutually uncorrelated components plus a Loglinear model mean that we can precisely decompose 100% of the market's observed growth into distinct component sources in the model. We then apply this model to the US corporate sector over the period 1952 Q1 to 2017 Q4. So to just give a quick preview on the results, what do we find has been the most important driving force behind the market's sharp gains? Well, it's not economic growth, it's not risk premia, and it's not short-term interest rates. Instead, we find what we will model as a factor share shock that reallocates the rewards of production without affecting the size of those rewards. So our estimates imply that a long sequence of shocks in the post-war period persistently reallocated the rewards of production to shareholders to such an extent that the realization of these shocks account for about 43% of the market's rise since 1989. Now, other factors also play a role. Declining risk premium explain about 24% of the rise since '89. Declining interest rates explain much less, 8.5%. And economic growth, well, that contributed only 25% since '89 and just 54% to the market's rise over the full 65-year sample. Now, there was a period where economic growth really was the key to the upswings in the market. If we look at the period 1953 to 1988, growth accounted for more than 100% of the, the growth in the economy accounted for more than 100% of growth in the stock market. But that was a 37-year period that created less than a third of the wealth generated over the 29 years since '89, when growth was very sluggish. So one implication of this that we want to emphasize is that the high returns to holding equity in the post-war period have been in large part attributable to a long sequence of redistributive shocks that have reallocated rewards to shareholders. So our estimates imply that about 2.9 percentage points of the post-war average annual log return on equity in excess of a short-term interest rate is attributable to this string of favorable shocks and not to genuine compensation for bearing risk. Okay, there's a related literature that I don't really have time to talk about. The papers closest to this one are our own previous work. We also touch on, but this paper differs in very important ways that I won't get into now, we can discuss later from our previous work. But we also touch on a limited participation literature, the literature that documents the decline of the labor share. There is a smaller literature that finds evidence that there's a negative correlation between the returns to human capital and the stock market. And we also relate to some recent macrofinance trends papers by these two authors in particular. Our findings are quite different in important ways from at least some of them from these authors, and I'll get into that in the discussion Q&A if there's interest and we have time. So here's our model. We have a representative firm for the corporate sector, and there are two types of agents. There are workers and there are shareholders. Now, this is a very crude distinction, but we think it actually is not a bad first approximation to the data, because wealth in the stock market is so heavily concentrated into the hands of few wealthy households that actually earn very little income from labor income. So workers will consume just their labor income, and shareholders are akin to a wealthy household or an institutional investor who finances consumption entirely from owning assets. Domestic output, Y, will be produced by a production function here. A is a mean zero TFP shock. N is a labor endowment, which is hours times a productivity factor. Workers inelastically supply labor, and hours are fixed and normalized to 1, but capital grows deterministically in steady state at a gross rate G, or little g in net terms, and labor productivity will then also grow at this rate. Now, some earnings accounting that we follow closely, the NIPA accounting. We're going to denote a fraction tau of output that is devoted to corporate sector taxes and interest they pay, and other, we'll just call it taxes and interest for short, where other is a catch-all for a series of other charges against earnings other than labor. Then the remaining 1 minus tau is divided between labor compensation and domestic after-tax profits, which will denote ED. Total earnings, E, of the firm also include retained earnings from firm's foreign subsidiaries. Let's denote that EF as the fraction F of Y. So E, we're going to define as this purple S times Y. And S is itself a function of SD, Z, and F. What is SD? SD is the domestic profit share. Z is 1 minus tau, so it gives us the after-tax profits. And F is the foreign earnings share of output. Now with this, labor compensation will be 1 minus SD times after-tax output. And so S, which is what we'll simply call as the earnings share, or sometimes the total earnings share, is just, we'll call that the earnings share. And 1 minus SD we'll call the domestic labor share. So what we can see is that what we're calling S actually moves inversely with the domestic labor share and moves inversely with the tax and interest share, and it moves positively with a foreign retained earnings share. So what is this S? Well, it's a variable that we will model as an exogenous factor share shock. This is just a reduced form way of capturing changes that could occur for any reason in the allocation of rewards to shareholders. We'll see that the labor share component, this 1 minus SD, is the most important quantitatively, and possible sources of variation over time in that include factors such as changes in industry concentration, structures that alter labor intensivity of production, or changes in the bargaining power of US workers, possibly because of increased international competition, changes in the prevalence of unions or offshoring. Technological factors could also play a role, altering the substitutability of labor for capital. Earnings from overseas affiliates and taxes and interest, and this other, we'll just call taxes and interest, make up the remaining components of the factor share process. So cash payments to shareholders, which we'll take as net payout, and we'll simply call those cash flows for short, will differ from earnings by net new investment. So here we will assume that the firm reinvests a fixed fraction omega of output each period, so that cash flows are earnings minus omega Y, or S minus omega in parentheses times Y. So the idea here is that this reinvestment is needed to achieve the long-term growth in output at the net rate G. What are we doing with this? This is a simple way to capture the empirical fact that firms in aggregate retain part of their earnings for reinvestment, and that this required investment depends on output rather than the earnings share. So as I said, equity in our model is priced by a representative shareholder who is akin to a wealthy household or a large institutional investor. The remaining agents will supply labor, but they don't play any role in asset pricing. Shareholder preferences are subject to a shock that will alter their patience and appetite for risk. Investors understand that the state variables in the model are subject to transitional dynamics and take these into account when forming expectations. So SH is short for shareholders. They'll have identical preferences, and if there are idiosyncratic shocks, they are drawn from the same distribution. So equity will be priced in this model by a representative shareholder who consumes per capita shareholder consumption, and in equilibrium, that will just be the aggregate net payout to shareholders. Now, this should be distinguished from a representative household model, which is the more common way of modeling things in asset pricing historically, in which the agent consumes per capita aggregate consumption. So this will not be true in our model. Instead, it will be an aggregate representative shareholder who consumes aggregate net payout. The intertemporal marginal rate of substitution of the shareholder will be the SDF in this model, and it will take this form. So you see there are two time varying parameters here, beta and X. The preference shifter X and the subjective time discount factor beta are taken as externalities, that is, as given by the individual shareholder, something akin to, for example, an exogenous habit or an external habit, and they're driven by the market as a whole. X will drive the price of risk in the SDF, and it affects risk premia. And then since an SDF is always reflective of either preferences or beliefs, we could interpret a decline in X as either a decrease in effective risk aversion or a decrease in pessimism. A time-varying beta is essential for obtaining a stable risk-free rate along with a volatile risk premium. Okay, and it has these two pieces that I'll discuss in a moment. Now we're going to work with a Loglinear approximation of the model that can be solved analytically. The only potential concern with this that we see is that potentially the earnings share could go above 1. It never does so, literally 0% of the time in a 10,000 period simulation, because the estimated earnings share process or factor share process is more than 14 standard deviations away from unity and steady state. So what follows, lowercase letters will always denote log variables, and all shocks will be modeled as Gaussian, independent over time, and mutually uncorrelated. So for TFP and output growth, we will assume that the growth in TFP is an IID shock that is normally distributed, which means that output growth is an IID shock as well. So log output is a permanent process. It follows a I1 process, and its growth rate is IID. Now, since E is S times Y, earnings growth is log, and log differences is just delta S times delta Y. So we will just model these two pieces separately, and that will give us the process for earnings growth. Remember that payout in the model is C, which equals S minus omega times Y. So we log linearize this equation around a constant payout ratio of output, which we'll denote as CY. An approximate expression for the payout ratio is given here. And this C parameter is S bar over S bar minus omega. Now this S bar is just the average value of S, which in the data will be the earnings share of output. We're going to generalize this cash flow equation so that it is a function of a vector with these bolded symbols are vectors. So the vector S allows us to model components of S as a mixture of multiple stochastic processes. Why do we do this? Because the data plainly suggests the presence of lower and high frequency components in S. We're going to model those as SLF for a low frequency component and SHF, so that S is additive in logs across these two components. So from this equation, that means that we will have bolded S equal to SLF comma SHF as its arguments. And this C, bolded C, is just a constant vector that has this parameter C up here in both of its elements. Now we'll specify the dynamics of cash flow growth as follows. So this just repeats that equation. We're going to specify a process for this factor share. Remember, there are these two components in here, which we'll specify then as a multivariate Gaussian process. If you see a tilde, that's just a d-mean variable, so S minus S bar. And then phi S is a diagonal matrix with the autoregressive coefficients of S low frequency and S high frequency in diagonal entries. This is the diagonal covariance matrix for these shocks. Okay, so we also have a risk-free rate of return, which is by definition the inverse of the expectation of this SDF, and that's going to depend on the beta, the subjective time discount factor, which has two parameters here. The data on short rates also suggests a low and high frequency components, so to keep it balanced with the other one, we will model those separately. So delta will be a function of two components, low frequency and high frequency. And it will also, these will be driven by a multivariate Gaussian process. Okay, so we have persistences of delta to measure, and we have a mean process in there as well. So the parameter D is a compensating factor that is chosen to ensure that the risk-free rate is just 1 prime, a vector of 1s times delta. That is the sum of these two components. Now, since we have Gaussian shocks and the SDF is conditionally log normal, the risk-free rate would take this form, which means that D has to take this form. So for the risk price dynamics, we're going to assume that the price of risk follows the following process. There are two components, this one and this one. Let's talk about this one first. X, I'll call this X perp for short. This is a perpendicular symbol, is a component of the risk price that is orthogonal to the economic state, that is to all other state variables, output, and factor share movements in the model. We will model this one also as subject to two components, a low frequency and a high frequency component, and they also follow a multivariate Gaussian process. Now, this lambda is again a constant vector that is the same parameter lambda in both entries. And what lambda not equal to 0 permits us to do is to allow a correlation between the earnings share and the risk premia, potentially because the willingness to bear risk rises as the profit share increases persistently over time. Now, in the data, what we see is that the log earnings share is positively correlated with the log price earnings ratio. It's also positively correlated with the CRISP PD ratio, and that's especially true over longer horizons. It would be impossible to explain this fact with lambda equals 0, since a transitory increase in the earnings share would lead to a decline in the price earnings ratio, and a permanent increase would have no effect. So the fact that we see a positive increase in the data suggests that this lambda is likely to be negative. Nevertheless, lambda is a parameter that we freely estimate under flat priors, so in principle it could be 0 if the data wanted it to be. All right, so we have a Loglinear model solution for the price payout ratio. We'll denote PC as the price payout ratio. Remember that C is payout in the model. This is consumption of shareholders. So we guess and verify this solution. I just want to make quick points about these coefficients here, right? So the fact that we see the coefficients, both of them on the delta and the coefficient on X perp as they would be negative, that's simply telling us that an increase in the risk-free rate or in the price of risk increases the rate at which future cash payments to shareholders are discounted, and so that drives down the price payout ratio. Now, if lambda were 0, then we would also have negative values for the entries in AS, which is the loading on the factor shares component, and that's because phi s is less than 1, so equity values would rise proportionally less than payout in anticipation of eventual mean reversion in payout without lambda, being some negative number or positive number. Now, if lambda is negative, these entries could be positive depending on the magnitude of lambda. Okay, so here's our solution, which is not very important algebraically. For the log equity premium, all I want to do is point out that because of the homoscedastic shocks, there is no variation coming in from the conditional volatility of R, which is constant, but instead risk premium, the equity risk premium would vary with this orthogonal risk price component and possibly with factor shares if estimates suggest that lambda is different from 0. All right, so we have a bunch of primitive parameters. We will, there's a whole bunch here. So we're going to divide these into two groups, a small number that will simply calibrate and the remaining parameters that are freely estimated. We use Bayesian methods, but with flat priors. The estimation of the latent states, because the model is Loglinear, we can use the Kalman filter. And then we confront the model with observations from 52 Q1 to 2017 Q4. And we have observations on output growth, the earnings share of output, EY for short, and notice that this is going to be a function of the domestic profit share, the after-tax share of output, and the foreign income share for the corporate sector. We have data on the risk-free rate, we have data on the equity to output ratio, and then we're going to discipline our risk premium process with an estimate. It's not actually an estimate, it's using options data to get an estimate of the risk premium that Ian Martin uses using the SFIX. We'll call this RP. So what Ian Martin does is use options data to compute a lower bound on the equity premium and then argue that it's approximately tight, which means it's a good estimate itself of the risk premium. Because of our mixture process for our orthogonal risk premium component, we can account for both the higher frequency component in the risk premium implied by options, as well as lower frequency components that might be implied by valuation ratios. The risk-free rate we just take as a 3-month T-bill minus the fitted value of inflation from regressions of inflation on lagged inflation. And then the observations on 1, 2, and 4 all are for the US corporate sector. Output, the earnings share, and the price output ratio need to be measured for the same sector of the economy in order to avoid confounding compositional effects. Now, we can relate all of those observable variables in the model to our parameter estimates, or our parameters, and our latent states with this system of equations, which we simply write in state space form this way. So here's our observation vector, and here are the latent states. Now, F, H, and B are just matrices of primitive parameters. And what I want to point out here is that we'll use the Kalman filter to give us smooth estimates of these latent states. And then in equation 2, we don't have any measurement error. And that is due to the use of a flexible Loglinear model, but also because we have 7 latent states to match 5 observable variables. So we can perfectly explain the observable variables at each point in time over our sample. Okay, so we have a posterior of theta. We obtain that computing the likelihood using the Kalman filter and combining it with priors. Because we have used flat priors, the posterior coincides with the likelihood, and the posterior mode coincides with the MLE estimate. The parameter uncertainty we can characterize using a random walk Metropolis-Hastings algorithm, and then we can characterize latent state uncertainty using the simulation smoother of Durbin and Koopman. So the error bands that you'll see reflect both parameter and latent state uncertainty. Okay, quickly we calibrate 4 parameters: the means of output growth, the risk-free rate, and the earnings share. And this is just to take a conservative approach of fixing them at their sample means, rather than allowing the estimation. Some of these series are persistent to estimate something that's different from the sample means. So the payout to earnings growth relation parameter, right? Psi here is the one thing that we have left, and we will calibrate that. That is just pinned down by the data. Remember that psi is S bar over S bar minus omega. And this is just given by, this is the payout to output ratio, which we mean payout to output ratio is equal to the mean earnings share minus omega. So we observe both of these, therefore we can pin down omega, therefore we can pin down psi, and that should be 2.19. And we confirm in our results that psi of 2.19 yields average growth and volatility of payouts that are close to those observed in the data. Okay, so let me just first show you some estimates of the parameters and the latent states. Here are parameter estimates. I'll just point to a few things. This is the effective mean risk price. It's relatively modest at 4. This reflects the volatility of cash payments to shareholders. Thus, we're not going to need outside risk conversion to explain a very large equity premium or average excess return on stocks in this model, because this fundamental measure of systematic risk is actually quite volatile. Okay. The persistence of our latent states are going to be very important for understanding what factors have driven the market over an extended period of time. So let's focus on those. Take the risk-free rate. The low frequency AR1 coefficient that we estimate is 0.93. And what this means is that the substantial declines recently in the risk-free rate do not rationalize anything near a permanent shift. And I'll come back to that again later. If you look at the persistences of the low frequency factor share process, that's much larger. Yet data say that that's around 0.98. And likewise, for the orthogonal risk price, that's around 0.986. Right? So these are factors that you might expect are going to play an important role potentially in the longer term trends in the market. Now, this lambda is the risk loading on the factor share process in the risk price equation. This is -8. So what this says at the modal estimate, what this says is that a 0.01 unit increase in the log earnings share, which is approximately 1% increase in the earnings share around the mean, would lead to a -0.08 decrease in the risk price. So let's look at our latent states. So we have the earnings share. Now, we have flat priors. Under flat priors, credible sets are known to be fairly wide, but I want to emphasize that the log earnings share, which is the data here, always the data are in the black, that the sum of the high and low frequency components always adds up to the observed series without any error, and that's because we don't have measurement error in our observation equation. Okay, so what this is telling us though is that the low frequency component of the factor share is what logically captures these swings in the earnings share, right? You see this upward trend over the sample is well captured by this piece, while the high frequency component captures the more transitory variation in the earnings share, but can't explain this full run up over the sample. Now, the risk-free rate, here's just a picture of our data. You can see real rates were low in the 50s and the late 70s. They shot up under the Volcker disinflation. and its immediate aftermath, and then they have declined over time, and they're low again in the period post-financial crisis. So the point here is that although rates are low today, they are not unusually low by historical standards. And so looking at the latent states for the risk-free rate component, you see that this low, high, low pattern for the risk-free rate is well captured by the low frequency component of the risk-free rate. And then these wiggles are picked up by the transitory component in the risk-free rate. Okay, so what about the risk premium? So what the left panel is showing is our estimated risk premium, the total risk premium, along with the premium implied by the 3-month SFIX, which is only available over a sub-sample of our full historical sample. So it's only available from 1996 Q1 to 2012 Q1. And so that's a black line here. But we plot those together. You see they lie on top of each other here. And so what this is showing us is that except for the big spike in the great financial crisis, right, upwards in the estimated risk premium, the equity premium has been declining steadily for decades and is currently at a record low value at the end of our sample. Now, if you look at just the period over which the SFIX is available, almost all of the variation in the premium in that period is ascribed to, that's implied by options data, is ascribed to the orthogonal risk price component, this X perp component, and it's the high frequency component. Okay, so now let's turn to some asset pricing results. Now, first, I want to show you some moments. So these are asset pricing moments in the model and in the data. Now, the model numbers here are numbers from many simulations of our model. The fitted numbers use the estimated latent states obtained from fitting the model to the historical data. So the fitted moments are the model's implication conditional on the observed sequence of shocks in our sample. They are therefore directly comparable to the data moments over here. Now, the fitted moments for the log difference in the earnings share, in the earnings output ratio, and in the risk-free rate match exactly the data moments because those are observables, and as I noted, we don't have observation error in our observation equation. The fitted moments for the log equity return, the log excess return, and the price payout ratio, which are given in these 3 rows, match the data moments reasonably well, even though these aren't targets of our estimation directly. Notice that the fitted mean excess return understates the data mean somewhat, and that is because the model understates the mean payout growth to some degree over the sample. Again, this is not an estimation target. It's still in the right ballpark, but this is the main reason that there is some discrepancy here. Now, the fitted mean log excess return of 6.6% is greater than the model mean log excess return of 3.7% by 2.9 percentage points. Why is that? This is attributable to an unusual sample in which there was a long string of factor share shocks that redistributed rewards to shareholders. In other words, this number is an estimate of the mean risk premium implied by our parameter estimate, and it reflects only compensation for bearing risk in the stock market that is covariance with the stochastic discount factor. This number also reflects covariance with the SDF, but in addition reflects the persistent movements in earnings and payout over the sample. So the divergence between the 2 numbers is attributable to the fact that the model stipulates a stationary earnings and payout share of output that can't grow in perpetuity. They're bounded below by 0 and above by 1, whereas the 65-year sample upon which the model is estimated exhibits strong upward growth in those shares. So you can see that here as well. The fitted means for earnings growth and payout growth are larger than the model means. And this is what I just explained. The difference between these 2 is what's happened to cash flows over our unusual sample. So what does this say? That this difference of 2.9 percentage points of the post-war mean log stock return in excess of a treasury bill rate is attributable to a string of favorable factor share shocks rather than to genuine compensation for bearing risk. So let's look at the equity dynamics now. Those are just static moments. And let's look at the role of factor shares in our target variable, which is the log market equity to output ratio. Again, the data are shown in black here. And what we're asking here is how much of the variation in our sample, you see this huge run up over our sample in market equity to output ratio, can be attributed to various sources. Here we're looking at the role of factor shares. And we do that with counterfactuals that hold fixed components since a certain time period, or allow only one component, allow one component to vary over time, or hold fixed one component over time. So up here, we see that, you know, if we allow only the low frequency factor share component to vary since 52, the longer term swings in the price output ratio are well captured by this component. Now, the high frequency factor share component just gets these little wiggles, but doesn't do anything to explain this big run up. If we were to fix both components, right, so that the only thing that varies is all the other stuff, the model is unable to capture any of the upward trajectory since about the year 2000. And we see something similar if we fix S at its value in 1989. In that case, only a small part of the upward trend since 89 can be explained. Okay, and you can see that by this large discrepancy here. Now, moving on to the risk-free rate. Risk-free rate really has a negligible role in these big swings. Either component is contributing very little. And you can see that here. This is what would happen if you just had the low frequency component, and here's the high frequency component. You know, if we shut down either the low or high frequency component, it does little to the model's ability to match the trend movements in the market equity to output ratio. If we, you know, look here, this says that the log market equity to output ratio would be about 0.2 of a log point lower had there been no change in the risk-free rate since 1989. Okay, how about the risk price, this orthogonal risk price piece? What do we see from this is that, you know, the low frequency variation in this is really what explains much of the transitory booms and busts. This is especially true of the tech boom and bust. It gets some of the run up in to the great financial crisis and its aftermath. And so it's driving a lot of these more cyclical changes. The high frequency component doesn't really have much of a role in these swings. And if we fix the risk price, this orthogonal risk price in 1952, we see that this risk price explains some, but not nearly all of the rise in the market equity to output ratio. And if we fix it in 89, a small portion is explained, a small portion of the run-up is explained by the decline in the risk price based on the modal parameter values. But notice that the credible sets here are quite wide, so there's a lot of uncertainty about whether this component contributed at all to the run-up since 89 in the market equity to output ratio. Okay, let me now turn to a growth decomposition in numerical, in a quantitative growth decomposition. So what I'm showing here is the total change in market equity over various subsamples of the period. And then what this is the portion of the run-up in market equity growth, the total growth in market equity over these periods that is attributable to various components in the model, component sources in the model. So factor shares, there's a low and high frequency component, the low and high frequency component of the orthogonal risk price, the low and high frequency component of the risk-free rate. So when you do this, you see that our model suggests that 43% of the growth in market equity since 1989 and about 19% over the full sample is attributable to these movements in the factor share, the earnings share that holds fixed the overall output pie. And almost all of this is coming from the low frequency component, as you can see here. 24% of the market's rise can be explained since 89 by a movement in the risk price. That means risk premium declining, and about the similar magnitude, 26% over the full sample. There is a much smaller role for the risk-free rate, and that can be seen here. Now, what about economic growth? Well, since 89, it contributed about 25%. And over the full sample, it contributed about 54%. That's a 65-year sample. So, you know, how is it possible that economic growth over such a long sample seems to explain so little? Well, it turns out that if you look at the period from 52, the beginning of our sample, to 88, you know, output growth explained more than 100% of the market's rise, because other factors, such as the risk-free rate, were drags on the growth in the stock market. Even factor shares were drags, the earnings share was declining. But that was a 37-year period that created less than a third of the wealth generated in the 29 years from the end of 89 to the end of 2017. So you can see that here by just comparing how much the market grew over these subperiods. Okay, so the bottom line is that the market has made far greater gains in much shorter time from 1989 to the present, when factor shares reallocated rewards to equity holders even as economic growth slowed. All right, so the last thing I want to show you is this slide. So now we can ask, okay, so we know that the estimates imply that factor shares or movements in the earnings share explained an important part of the run-up. Now, what explains the upward trend in the earnings share? So to remind, the log earnings share is a function of positively related to, it's negatively related, inversely related to the domestic labor share, inversely related to the tax and interest share, and positively related to the foreign share of earnings, retained earnings. So what we can do is similar to what we've done, take the total change in the log earnings share, which is shown in black, and then ask what component of that is driven by various pieces. So in the top two slides, we allow only one component at a time to change, and in the bottom two, in the bottom row, we fix one component at a time. So here, what this is telling us is that if only, you see the blue line is the labor share component is the only thing that varied since 1952, or here we see since 1959, then the declining domestic labor share really accounts for the bulk of the rise in the earnings share. You can see that we mimic the total rise in the earnings share quite closely, just with the decline in labor share. The tax and interest share basically is you can't even see it because it's you know, I mean, sorry, you can't see it down here. You can't really see it's doing it. You can see that it's not doing anything. This is what this green line is. Okay. Now there's a small role for foreign earnings, right? Foreign retained earnings, as corporations have shifted some of their production overseas, but it's not as large. And we get a similar idea if we do the opposite, if we fix one component at a time. So here, if we fix the labor share since the beginning of our sample, or if we fix the labor share since 89, we can see that, you know, this is what we would get. We really wouldn't explain any of this run up. If we fix foreign retained earnings share, right, you see that we wouldn't get the full run up here, but we get most of it. And if we fix the tax and interest share, that really does nothing. Okay, so I'm gonna just summarize, and then I'll be done with my portion and we can open it up to Q&A. So what have we done? We have asked the question, why has the market risen so much over the post-war period, or why does it go up and down? What are the factors that drive it? So we estimated a flexible parametric model to address this question that allows for influence from several latent components while inferring which values those components must have taken over the sample to explain the data. And what we find is that the high returns to holding equity over the post-war period are due in large part to effectively good luck, to a string of shocks that reallocated rewards of production towards shareholders and away from other claimants, principally labor. Now, the realizations of these shocks added 2.9 percentage points to the mean log excess return. And according to our estimates, that would mean that the mean log excess return would overstate the risk premium by about 44%. For the 37 years from 1952 to the end of 89, economic growth was the factor that drove the stock market entirely, but that was a period that was comparatively lackluster for equity values, creating less than a third of the wealth generated over the 29 years from the end of 89 to the end of 2017. I still have 5 minutes, but I'm
yeah. We can start it now. So thank you so much, Sydney, for a really interesting presentation. We're now going to go into the Q&A part of our webinar. And so I just want to remind everyone that's partaking here that if you want to ask a question these days, that you can use the raise hand feature, and we'll try to get to you. Okay. We're going to start out here with a question from Lucas Schmidt from USC. Lucas.
Hello.
Hello.
Can you hear me?
Yes.
Yeah. Hi.
Lucas.
Okay. Thanks a lot. Great presentation and very interesting work. I have one question which I've been thinking about a little bit. So it seems to me that fundamentally the model is predicated on the view that the post-war economy is fundamentally stationary. So there is time duration parameters, but ultimately it's a stationary economy. And I was wondering how we should think about structural change in Indian economy in this context. You know, there was probably changes, the advent of computer technology, there's changes in monetary policies, there's a China shock. So how should we think of this in this context? So it seems to me that the model implicitly assumes that investors after World War II assumed or put some probability on the possibility that that interest rates are going to be very low for a long time around these days, and that by now they should expect a mean reversion. So it seems to me one could also think about the setting in which investors learn about the dynamics economy and will probably update some of their views about what's happening in the economy.
Yeah, Lucas, thanks a lot for your question. And Lucas has a related paper, and this is Lucas's paper, and it's similar to Fari and Gurio. And so let's just address that, because I do think that we're estimating things and finding things that are quite different, partly for the reasons that Lucas raises, which are a very good question. So our results, let's step back, our results differ from these papers, including Lucas's paper in some ways. They're actually similar in other ways. So I think we all of us are finding a role for changing factor share, what we call factor shares. But these papers find that falling interest rates play a crucial role in driving equity values over recent decades. And they also find that while we find a small role for falling interest rates. And then they also conclude that risk premium must have risen over the period, at least since 2000. So we find the risk premium are at historic lows. So what's behind these differences? And Lucas foreshadowed what's behind them. Lucas's paper and Fario and Gurio's paper measure changes across steady states in which the parameters can change only permanently. Therefore, what you guys are interpreting as an observed drop in risk-free rates, for example, is a permanent shift, leading in your model to a huge increase in market value. And then since the implied increase in market value from the falling interest rate would have been even larger than the actual increase observed, these models would infer that risk premium must have risen at the same time. So our model, by contrast, views these interest rate changes as far from permanent, because we estimate the entire dynamic model and the individual persistences of these components. Now, it won't surprise anyone that we view our approach as strongly preferred by the data. And to support this claim, I just want to appeal to the next figure, which shows that we match the autocorrelations in the variables very well. So the autocorrelations in the risk-free rate would be deeply inconsistent with a process dominated by permanent shocks, for example. And so that's what we're showing here. This is showing you from long simulations of the model, what our autocorrelograms look like, and for various series. This is for output growth, the log earning share, the risk-free rate, and the log market to equity ratio. So both in the model and in the data, you can see that these autocorrelations for output growth hover around 0, suggesting a near IID process. The autocorrelations of the earning share, of the risk-free rate, and of the price output ratio converge to 0 and suggest persistent but stationary processes. And if you look at the risk-free rate in particular, the autocorrelations of the risk-free rate converge to 0 at a quarterly lag 35, while those for the price to output ratio, the market equity to output ratio, are still above 0.5 at that lag. So this simply tells us that, you know, it's going to be very difficult to explain these much more persistent movements in the market equity output ratio with the risk-free rate, which is simply much less persistent than that. So, you know, you can assume permanent changes. What we have tried to do is look at the data in our model. Investors, you know, did not believe that interest rates would remain permanently high in the 1980s, and nor would they expect them to remain permanently low today, and that simply is why it dampens the effects of the fall in rates on the value of market equity.
Hi, this is Dan. So just to follow up quickly on that, I think the way Lucas said it is exactly right, which is that our model is estimated on past data, and in the past, once you take out inflation, the risk-free rate has not been very permanent at all. It's been quite transitory. But the question now is, do investors believe that this time is different, that somehow we've had a structural break and now we have much more persistent changes in the interest rate than we've had in the past? Or will the future continue to follow the historical pattern? So of course, our model believes it can only see the past, that it will continue to follow the historical pattern, but it's a great question for debate.
I just, you know, one more thing on that. If you just look at the plot of the interest rates, I just want to point out, though, that, you know, I mean, when do you assume whatever's happening? It wasn't long ago before interest rates spiked up again. So, you know, we might be in a whole new world, but I guess what we struggle with is how to know for sure what evidence are we basing that understanding on.
Okay. Thank you. So we had a question from Laura Belkamp from Colombia. If you're around.
Can you hear me?
Yes.
Okay, so I'd actually put my hand down because it is sort of a version of Lucas's question, but I just wanted to point out that these, first of all, hi to everybody. It's great to hear from you, and I enjoyed the presentation. These factor shares are production technology coefficients, right, that reflect how important is this ingredient as a factor of production. And so when we shifted from agriculture to industrialization, capital becomes a more important ingredient of production, and so, you know, its share goes up. And when that happens, I'm pretty sure people weren't sitting around asking, well, I think we're going to slowly mean revert to agriculture, right? And so what's happening now is we're shifting towards a more IT-based economy, which involves even less role for labor. And so it sort of makes sense. It's unfortunate in many ways, but it makes sense that the return to capital is going up. But similarly, I don't think we're sitting around saying, wow, I wonder when these computers are going to mean revert and we're going to go back to being typists. So I get what your answer is about interest rates, but I still don't really see it as like a practical, plausible economic story that we think that technological change is going to somehow march backwards.
I'm happy to take a shot at this one.
Yeah.
If that's okay. So you know, sorry if you can hear a baby in the background. Basically, the model is estimating this persistence based on the data. So it's free to choose that the factor share shifts are permanent. You know, it does have two components to work with, and it's kind of chosen one that's highly persistent but not completely permanent. That said, I'm sure an economic case can be made that actually maybe these changes should be more persistent. The only thing I'll point out is that would actually make the role of factor shares in our model stronger. Basically, the more persistent the shock, because we have forward-looking investors looking at profits, you know, many years in the future, the more persistent the factor share shift, the larger the effect on current asset valuations. So I think this is maybe a more conservative assumption than the kind of compelling story that you lay out in terms of the effect on valuations.
Yeah, can I follow up on that? Thank you so much for the question, Laura. I just want to show you a plot. So we updated the data, and I'm just going to show you something from 2005 Q1 to 2020 Q1. Okay, so this is just showing you earnings share, year-over-year growth in the earnings share, year-over-year growth in the labor share, domestic labor share. This is the level of the earnings share and the labor share. I'm just kind of interested to look what happens to these shares around recessions and you know, how do they change over time. So you do see that the earnings share growth fell some as we got into the Great Recession, but then it popped way up right? And then comes down and hovers sort of around 0, but is more negative later on. The opposite sort of pattern happens in the labor share. So if you just look at the levels, you see this big increase in the level of the earnings share after the crisis, and then it starts slowly declining. So the labor share, an interesting fact is that, the labor share slowly recovers, but it actually still hasn't quite reached the level it was at the end here, right? But it is slowly coming back up. So I think there is a component of the low frequency labor share, or of the total labor share, that is really high frequency. There's a component that does sort of slowly mean revert. It's also possible there's a third component that is sort of shifting permanently around that we haven't modeled. You could imagine modeling yet a third component.
Okay, let's take another question. Let's go to Francois Guriot from the Chicago Fed. Francois?
Yeah, can you hear me?
Yes, thank you.
Okay, yeah, so my question is conceptual, because you try to decompose the changes between the different sources, growth, risk, and factor shares. But it seems you have an assumption that the factor shares affect this premium, right? Because they are priced. So these things are actually not really independent, right? So when you show the decompositions, how do you do it?
So yeah, good, thank you. Let me go back. The decomposition, right, this one, this is the part that's orthogonal, right? And this includes this includes whatever is happening due to labor to the factor shares, right? If lambda, we don't assume that they move together, but we estimate that lambda is non-zero, right? Which makes sense because, as I explained, you can't really explain the data without a negative lambda, because what happens is that as earnings shares have persistently increased over the sample, that's coincided with a rise in valuation ratios. So it's really impossible to explain that positive correlation without, it's sort of, think about like the Campbell-Cochran model where risk aversion declines as times are better. Well, here in our model, times are better whenever the earnings share goes up and cash flows, corporate cash flows, go to shareholders more. And so that's what the data seem to want.
Okay. Unless Francois has a follow-up, then I'm going to move to Maria Chadarina from Oregon. Okay. I think Maria is gone. So if Kenneth Ahern is here. All right. I think Ken might be gone. I'm going to ask Ken's question. So hold on a second here while I find it. Here we go. So Ken had an interesting question regarding the role of debt. So I just want to get to that. The economic output in your model is split between equity and labor, but what about debt? On average, firms have about a 33% debt to assets, which varies over time. So I think that's the main point. The stock market data uses levered returns, but your model uses unlevered returns. How would including factor shares to debt change your results?
Yeah, that's a good question. We don't have, it could be that another reason that payout over our sample grows so quickly is that for whatever reason, firms are just taking on debt and using it to pay out. And we don't really have that in the model, right? So I think it's possible that because we don't model debt, this is one of the reasons why we sort of understate payout growth relative to, you look at this figure versus this one, relative to the data. So, that how would it change? I mean, if we were going to model debt, would mean another state variable, we would model it probably to try to close that so that we could just make that gap go away.
Can I just, do you know what the leverage ratio looks like? Is it true that there has been, for instance, more debt in the last, I'm just not sure. Do you have any idea of those dynamics, what they are in the data?
I thought Dan, we looked at some debt data at some point. Did we not, for the corporate sector? Do we have that? We have some data on that?
We have the data, but I don't remember the cyclicality. Sorry.
Okay. All right. Let's go to the next question. Nicola Gurga, the Vienna Graduate School of Economics.
Hi, can you hear me?
Yes.
Yes.
I have two quick questions. So the first question is related to, so basically you're saying, you're talking about the rise in market. For an important part of the data, we are talking about the firms which are listed on the stock market. So basically we're talking about market capitalization. So market capitalization is price times stocks outstanding. So can you tell that in this second part of your sample, does the growth that we see is coming from the prices, or I mean from the rise of the prices, or it is because there is a change in this number of the stocks outstanding? So that's the first question. And the second part is I would just like to hear the comment on this, how do you say this, risk premium part, where you are having two parts. So basically you are having this orthogonal part and this labor share part. I'm just trying to understand whether the whole factor share is the part of a risk premium, or just it's a high frequency part. So those are my two questions. Thank you.
Okay. So our market equity is price times shares outstanding. That is true. I'm trying to think, but I think since like after the tech bust, there were more buybacks on net. Buybacks, share issuance was negative on net. So that if anything, so P times number of shares, you would have to have seen a big increase relative to the number of shares. During the, again, trying to scratch my head with memory of when we looked at this a while ago, during the tech boom, right, there's a huge amount of net issuance, and so that would have gone the other way. But especially since then, I think that there's been net buybacks.
But just to follow up quickly, so to be clear, we're using some, because we want everything, including the profit shares, the output, and the equity valuations to come from the same consistent data set, we're actually using the flow of funds to determine the value of market equity and the payouts, which include both true like net dividends as well as repurchases, as opposed to working off something like CRISP, which has a price index attached to it. So it's a little bit harder to trace out exactly that in our data, but certainly repurchases play a big part of payouts, especially in the recent sample.
Yeah, and your second question was how to interpret the orthogonal risk price from the other piece?
Yes.
Oh, thank you. So, I mean, again, actually the first part of this paper, the first time we wrote, the first draft of this paper, we just had the orthogonal piece, and we were having trouble matching certain things because, let's go back to this thing, because of this problem here, which is in the data, valuation ratios are positively correlated. Things like PE in our data are positively correlated with the earnings share. And you're just not going to be able to explain that with the stationary earnings share process without having a component of the expected return that varies inversely with the earnings share. So the sort of idea is like, well, what if we allowed risk premia to vary inversely with the earnings share so that, investors effectively become less risk averse as the earnings share persistently increases over time, or shareholders become less risk averse. So that this lambda thing here was just something we needed to match the data, and we freely estimate it. It is clearly different from 0. And so that's how we ended up with that. Now, this part here, I mean, if we want to say what component is attributable to X versus Y, we need to have some way to orthogonalize stuff. It doesn't mean that all of these sort of the concepts of these variables in the data are actually orthogonal, but what we're measuring then is the part that is orthogonal. And so our estimates will give a sense of how important the variation in those orthogonal components is, because after all, the estimate could say, well, you know, the standard deviation of the orthogonal risk price shock is effectively so close to 0 that there is no orthogonal variation. That's also not what we find. This part, you know, is estimated to have some variation. So that's how I would interpret these orthogonal pieces, is that there are components that are, you know, mutually uncorrelated, and that's what we're picking up.
But Nicola, my takeaway from your comment and from Francois as well is that there's demand to see the decomposition between the raw effect of S on cash flows and the risk premium effect. So we'll be happy to add that.
Okay, thank you. Thank you very much.
Great. Next question is from Hiro Yoshida from Penn State.
Hello?
Hey,
Can you
Hiro.
hear me? Okay, hi. So my question was whether the aggregate factor share changes came from changing the factor share in each firm or changes in the composition of firms. For example, it's related to a previous question about technological change. Some firms have more need to for capital, and other firms have more needs for talent. And depending on the importance of capital and elasticity, etc., you know, the factor share can be different by firm. So my question is whether it's really for each firm or composition.
Yeah, I mean, I unfortunately don't think that our model, our data and our aggregate model has much to say about that. I think that's a very interesting question. I think it's an important question. You know, we sort of say here, this reduced form way of capturing these things, and you know, your question revolves around, is it sort of more this piece or something else? And you know, I think for follow-up work in the future, it's a super interesting and important thing to do. And actually, Dan and I have been working. We put that aside to try to finish this, but we also have been thinking about these issues and ways to use data to get at the answer to this question. I think it matters why. You know, it probably matters for lots of things why these shares are moving around, and for our understanding of what's going on, for sure. So I just don't, you know, we're not able here to say much about that, and that is something for future work.
All right, great, thank you very much. Next question, we'll go to Mikhail Proshletsov.
Hello, can you hear me?
Yes.
Okay, my pleasure. Thank you very much for the presentation.
Can anyone hear?
I can't hear him. Mikhail, I can't hear you. We did hear you, but you disappeared. All right, you know what? We are gonna go to the next question, and hopefully Mikhail can get his microphone up. So let's go to Sonali Hazarika from Baruch College.
Hi, yeah. So he answered the question I had asked on the text, but one of the questions I was thinking about was, like Kenneth talked about debt, you know, but there is also a lot of investment in private, right? So we have both private debt and private equity. So one is obviously the VC component, but even other private equity, because a lot of firms over time have basically gone off the equity market. So is that something you've considered in the model, or is it already there? So any comments on that?
Well, I guess thank you for the question. Our data, okay, for the corporate sector includes, it's not just publicly traded stuff. So we are, again, everything's so aggregated. We haven't, we don't know. I believe that mostly what's driving these booms is the publicly traded sector. It's the largest. But we're looking in our data description, corporate equity. It uses data on, it's from the flow of funds, blah, 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 blah. But it's also got an estimate of private equity issuance from Dow Jones Private Equity and Analyst and PricewaterhouseCoopers Money Tree report. So, it could be that something is happening with private equity that's quite important relative to public equity. We don't see that, but we are, this is just corporate equity as a whole, including private equity.
Right, and the reason I kind of was thinking about that is because especially your point about risk premiums not rising over time, right? But if you bring in the private part of equity or debt, that could change the risk premium to public equity. If that's also part of, it was in that context that I thought about that.
So you're saying that you think that
I'm saying that there is a piece of the market which is not captured.
Yes. So if you have two types, let's say you have people that just want to invest in private equity and others invest in stocks, and they have sort of different risk aversion levels on average, that compositional shifts over time could be part of the reason for our changing risk price.
Right. Yeah.
That's an interesting idea.
Yeah.
Unfortunately, we can't really get at that with what we've done. But
compared to CRISP or something, we are going to capture a lot more private firms because we captured the flow of funds corporate sector, which I think includes a lot of private C corps. Maybe there is some question about how good the data is on the market equity value of these corporations. We would miss a lot of things like pass-through corporations, I think, and S corps, which people have pointed out have also been rising over time. So it's something we can continue to think about. Like Sydney said, I'm not sure how much we can do, but it's a great point.
Right. And one of them would be pitch book. So especially for private debt or private equity, that's another source of data.
Yeah, our biggest challenge has been we need to do this breakdown. We need to have, for the same sector of the economy, not just a measure of market equity, but a measure of the earnings share, divided out between the earnings share and other stuff like the labor, how much labor compensation there is, right, and how much output. And so, yeah, it's not, if you know of a source, for example, that gives you all of those things for private equity alone, it's hard enough to find it just for publicly traded firms, good data on things. But then that's really the limitation that we face with just immediately answering your question using the data that we have.
Right, no, that's fair. Okay, thank you.
Okay, thank you so much. We have reached our full time, and thank you to everyone for partaking in a lively discussion. And thanks so much to Sydney for a great presentation. We want to highlight, of course, that we're back next week, and we're going to have Pierre-Colin Dufresne from EPFL presenting at the same time. So thank you, everybody, and see you next week.
Thanks, everybody.
Thank you.